right, welcome everyone. Thank you for joining us today for Our Region, Our World Economic Outlook into 2021. The event will focus on the new economic conditions and outlook for Southwestern Pennsylvania, the United States, and global markets in 2021. There is plenty to talk about already on today's agenda, and with today's promising news of a vaccine, we've seen a flurry of positive activity from the market, so this couldn't be a more timely conversation. My name is Betty Cruz, and I'm the president and CEO of the World Affairs Council of Pittsburgh. We're hosting today's event in partnership with the Economic Club of Pittsburgh, and we thank you so much for your partnership. And we thank all of you who are joining us here today. Now it's my pleasure to introduce you to today's moderator. Allison Treester is the Senior Director of Talent for the Allegheny Conference. In that role, she supports the overall regional talent strategy to make Pittsburgh, the region as a whole, more competitive. Allison previously worked for human rights and refugee organizations, both in DC and in Pittsburgh. Allison, thank you so much for facilitating today's conversation. Please take it away.
Thanks, Betty, and thanks everyone. Good afternoon. It's great to join you all on this beautiful day in Pittsburgh. Not often we see 72 degrees in November, so we'll take what we can get. And I'm happy to introduce our two distinguished speakers today, Bill Adams and Mekael Tashoma. Bill is the Senior Vice President and Senior Economist for the PNC Financial Services Group. In this role, he contributes to analysis of the US national economy and regional economies within PNC's core footprint. He's responsible for forecasts of international economic conditions, interest rates, and exchange rates, covering major foreign developed and developing economies. Mikhail is Vice President and Senior Regional Officer of the Pittsburgh branch of the Federal Reserve Bank of Cleveland. And in his role, he's responsible for managing relationships with regional stakeholders in Western PA, Southeastern Ohio, and the Northern Panhandle of West Virginia. He's also responsible for monitoring the region's economic environment and conducting economic research and analysis. Thanks so much for joining us this afternoon. You know, as Betty said, there's a lot going on in just the last 48 hours to reflect on, so I think we're all anxious to hear your comments. But before we get started, we'd just like to ask participants a couple of questions with a poll. So Olivia, if you can go ahead and launch the first question, please. So based on the results of the US presidential election, are you more or less optimistic about the future of the global economy? If you can just go ahead and answer more, less, or unchanged, we'll give you all a minute to respond. We need some Jeopardy music to commemorate Alex Trebek while we're waiting. All right, so we'll give everyone another minute or so to respond. And Olivia, when we get about the majority of folks, we can go ahead and push those results. Okay, so it looks like the majority of folks are more optimistic, so that's good. We could use a little more optimism, and hopefully Mekael and Bill have some positive news for us. And then we have one more question before we continue on. If you can launch the second question, please. So do you believe the economy is in better or worse shape relative to 6 months ago? Better, worse, or unchanged? We'll give you another minute to respond to that one. think if we can go ahead and push those results. Okay, so it looks like 52% think better. Even combined with the worse and unchanged, it looks like, again, you know, some optimism that things are moving in the right direction. So we'll wait and hear from the guys to hear if that's the actual case or just how we're feeling. Hopefully both. Again, a reminder, you can ask questions throughout the presentation using the chat function, and we'll get to those toward the end. Looking forward to hearing from you. And with that, I will turn it over to Bill. Thanks so much.
Thank you, Allison, and also thanks Betty and Yvonne from the World Affairs Council for helping to do this event with us. This is a fun collaboration. I'm excited that we can get together virtually with the World Affairs Council and also with all of you. Thank you for joining us today. Let me pull up some slides. You're not talking to an economist if there aren't slides, so I can get that. There we go. Let me talk you through quickly kind of where we see the U.S. and global economy right now, and what we expect in the next in the next year, given where we are. So through the October jobs report, we've had the first of all, we had the biggest plunge in U.S. employment on record in the months of March and April. Through the October jobs report, we've recovered 54% roughly of the drop in payroll employment in the United States. So we've had, if you compare the kind of slope up, the increase that we've had back from the bottom in this downturn, we've had the fastest recovery on record in the U.S. That's the good news. The bad news is that the level of employment relative to where we started in this crisis, we're still worse off than at the worst of any historic downturn going back to the 1970s. And so we've made a lot of progress back in the initial months of the recovery. Recovery has slowed recently, which is it's expected that the recovery would slow. We're still seeing very good job growth on an historical basis in the U.S. We've had 600,000 to 700,000 jobs added per month in the last 2 months, but we're still employment's still down by 10 million from where we were prior to this crisis. We have a long way to go in the United States to get back to a more normal job market. We've had a ton of fiscal stimulus pushing the economy along the way over the course of this recovery. This is the Paycheck Protection Program, the $1,200 tax credits to households, the increased unemployment insurance, the additional $600 per week that unemployed Americans were getting through the end of July, and then the $300 to $400 per week that most unemployment insurance beneficiaries got in August and the beginning of September. And so all of that has added a ton of momentum to the initial stage of the recovery for the US. Now, with the slowing in the recovery that we've seen the last few months, we've also seen some of that boost from fiscal stimulus has started to wear off. The additional unemployment insurance benefits the legislative one ran out at the end of July. The one granted by executive order that ran out of money in September. So unemployment insurance beneficiaries are receiving less money. But we are, with the recovery of employment, we are seeing a recovery in market-sourced income for Americans, so that is that's a positive sign. Household balance sheets came into this crisis in relatively good shape, and the household saving rate rose, boosted by this fiscal stimulus early in the crisis, and that has really cushioned the impact on the average American consumer and helped activity and real GDP to bounce back quickly. So The unemployment rate in the United States is down to 6.9% in the October jobs report. That's much better than 15% in April, which was the worst since the Great Depression. But the unemployment rate is an average. And while the economy overall has been improving quite a bit, the picture is very different if you're looking at the hardest hit sectors and occupations in the United States right now. So I highlight some of these here. Accommodations industry, personal care. If you look at accommodations as well as transportation and material moving, that's the orange line. That's capturing some of the impact of this downturn on the tourism industry, and that really is going to be one of the hardest hit industries. It's going to be one of the last parts of the consumer economy to recover. I think the news this morning of that vaccine trial being if that vaccine trial being highly effective is very encouraging news for the outlook for tourism. But in the near term in the United States, with much of the country still hitting daily record highs for new cases of coronavirus, I think the risk to those service industries, all the parts of the economy that require people to congregate near each other to function, the risks are to the downside that we could see the government forced to reimpose restrictions on activities to prevent hospital emergency rooms from filling up. So that side of the economy is still quite hard hit. With it, food prep and serving, personal care and services, so that's hair salons, nail salons, and so forth, and the restaurants and hospitality industry also are seeing unemployment continue much higher than the U.S. national average. We're also seeing a divergence in labor market conditions by demographic groups. The disparity in the unemployment rate between all Americans and Black Americans and Latino Americans had narrowed considerably in the late years of the long expansion from 2009 to early 2020. That divergence has widened again. As Mikhail talked about that, the Fed has started to explicitly incorporate the measures of not just the overall unemployment rate, but also looking at unemployment among Black Americans and other groups that historically have participated in the expansion later in the expansion, looking at that as it's calibrating monetary policy going forward. There we still see a lot of room for recovery. Similarly, looking at the employment rate or the labor force participation rate of women versus men, something very unusual about this downturn has been, typically you see more cyclical employment for men than women during recessions. Men there's a larger share of men working in construction and manufacturing and these more highly cyclical industries, and so you usually see more volatility in men's employment and labor force participation. In this cycle, that was true for the early stage of the recovery, but in the last 2 months labor market data, we saw the labor force participation rate for women dropping, and it's now down more relative to where we were when this crisis began than men's labor force participation rate. So this is spillover of the remote schools and other service organizations being either being closed or less able to deliver services, and childcare and other caregiving responsibilities are falling disproportionately on women, and that is a downside risk to the recovery. As long as that's true, that's going to hold back the ability of the U.S. economy to get back to normal. So we have a lot of cross currents in the U.S. On the one hand, we have the incredibly powerful fiscal stimulus. a lot of monetary stimulus from the Fed, and then, but we also have we're coming out of the most severe downturn on record. What that looks like is that the parts of the economy that are able to adapt to social distancing, adapt to the pandemic, and adapt to the constraints that puts on daily life now, are actually doing quite well. And you see this in consumer spending on goods. This is the purchases of this is car sales, this is recreational equipment, this is consumer spending on home refurbishing, and all of the things that people are still able to do with the restrictions of the pandemic in place. And consumer spending on goods is well above where it was in February of this year. By contrast, if you look at spending on services, that means in restaurants, travel, hotels, entertainment, movie theater tickets, so forth, that is still well below where we were prior to the downturn. And it's hard to see a recovery of that until people are no longer concerned about the effect of the pandemic on daily life. The big bounce in the stock market that we saw this morning, financial markets are forward looking. That means they're anticipating what the future will be like. And so with this sign that the vaccine this vaccine could be highly effective, that is a hopeful sign that we could see these service industries recovering in 2021. But so far we don't see that, and it's hard for that to happen before the pandemic gets under control. On the housing market, this is one of the sectors that has benefited the most from this recovery. We've had the strongest measures of many housing construction activities and home sale activities since the middle of the first decade of the 21st century in the last few months. On the other hand, the area of housing that looks more vulnerable right now is the rental market. So one of the big contrasts of this downturn to the last downturn in the United States is that the last downturn, there was a housing crisis. It was a crisis of homeowners, a crisis of foreclosures. If we see a housing crisis in this downturn, and I'm not saying that we will, but it's something that I am watching for. I think the area of concern is much more on renters, on the multifamily segment, and on evictions. This is data from the census's survey of households, which they were through the end of October. They were conducting every 2 weeks, and that survey showed that about a quarter of households didn't think they were going to be able to make their next rent payment. That's a quarter of households that are paying rent, and among households that are behind on their rent payments, 2 in 5 were thought that they were at risk of being evicted in the next 2 months. So that is now that can change if the labor market continues to improve, if more of those households are receiving income from getting their jobs back, or it could improve if there's another round of fiscal stimulus. That's an area where there hasn't been as much movement in the last few weeks, but still is a possibility. But that is one of the vulnerabilities of the U.S. job market and U.S. economy that I'm watching right now. On overall employment and unemployment, PNC is forecasting for the unemployment rate to continue to decline through the end of this year, and to fall in 2021 as well, but fall slower. Right now we're forecasting an unemployment rate of 6% at the end of next year, and around 5% at the end of 2022. So getting back towards a more normal job market. Not a great one, but not like we had at the beginning of 2020, but much better than where we are today. We're expecting for real GDP to grow at an above trend pace in 2021 as the economy gets back towards normal and more of those congregate businesses can function more normally. Risks are though I think risks are mostly to the downside to that forecast. The possibility that the pandemic continues to worsen before we have an effective vaccine, or the risk that we don't see additional rounds of fiscal stimulus. Both of those could mean a slower recovery and a higher unemployment over the next 12 months than we've seen so far. To the upside is the possibility of the vaccine. If it is as effective as the test this morning signals as possible, if people decide to get it, if people are willing to be vaccinated, and if the vaccine is rolled out quickly, then we could see growth better than forecast. But again, I think I see more risk to the downside than the upside. With the US economy still having a large degree of slack, we think that inflation is going to be quite cool over the next 12 to 24 months. Very low prices of energy, oil, gasoline, other commodities also are pushing downward pressure on CPI inflation in the United States. Inflation is not really a concern in the US in the near term. So a quick tour around the world. I mean, this crisis has hit everyone, and the impact has been very similar in Europe. It struck a little earlier than the United States. The initial lockdowns in the Euro area and in the European Union began in February and then into March. And then the European Union was brought the coronavirus under much better control than the United States during the summer months. In the last couple of weeks, the virus has become worse, and new cases have been higher in the EU on a per capita basis than in the United States. And so many EU states have reimposed restrictions on businesses, reimposed partial lockdowns. So there is that is going to be a drag on their economy in the near term. The good news for the European Union's economy is that a lot of the vulnerabilities of the European Union system, single currency, but multiple fiscal policies, those vulnerabilities have been addressed much better through this crisis through a joint fiscal policy. The first steps towards a joint fiscal policy being conducted by the European Commission, the government of the EU, and funded by a bond issued by the European Union. So that first step towards more fiscal cohesion in Europe, as well as a lot of fiscal stimulus from the strongest of the European economies, especially Germany, that has meant that the European Union is getting through this crisis better and faster, I think, than the European sovereign debt crisis of 5 to 10 years ago. In the United Kingdom, and I apologize, I have all the controls are kind of covering up my slides a little bit, so I have to look carefully to see what I'm looking at. In the UK, similarly, we're seeing another lockdown, which began November 5th. There's going to be a drop in real GDP at the end of this year. The UK is also dealing with uncertainties about Brexit. Supposedly, the British and EU negotiators need to reach a deal by November 15th if they're going to have an economic trade policy in place at the end of the year when the UK stops participating in the EU common market. They haven't gotten to that deal yet. It looks like the deal is close, but we're still kind of waiting until the last moment to see what that will be. And in China, we have this slide looks even more striking if I had updated the data through this morning. The yuan has recovered really sharply over the last couple of months. A couple of factors at play there. One is that China's economy is recovering earlier and more robustly than the rest of the world. China has far less prevalence of coronavirus. And that has allowed service sector businesses to reopen there and domestic tourism to recover. China's also seen its consumers starting to reopen their pocketbooks, and a lot of the consumer spending that was deferred earlier this year because of the coronavirus downturn. As the economy has picked up and people have become more confident that they're going to have their jobs, consumer spending is also growing in China. And finally, I think the drop in the yuan in the last couple of months is also reflecting the election outcome here in the United States. Financial markets anticipating a less unpredictable U.S.-China trade policy and dialogue, and that's flowing through to a stronger Chinese currency. Now, what I point out is that if you look back to, I'm not sure if you can see my cursor or not, but look back to May on the chart, where the yuan was close to its weakest in years against the US dollar. That was when China had just passed a new public security law that would allow the mainland authorities to have more authority over what happened in Hong Kong, restricting the autonomy of Hong Kong. And President-elect Biden has said that he's criticized China's conduct in Western China, where China has created re-education camps and a million or more ethnic minority Muslims have been sent to those re-education camps. There's tensions over Hong Kong. There are tensions over Taiwan. And in addition to those political tensions over human rights, there's also the longstanding trade issues that I think will still be contentious between the US and China. And so I think political risks are to the downside in China. So with that, I will turn it over to Mikhail to talk about the rest of our presentation. Mikhail, all yours.
Thank you, Bill, and good afternoon, everyone. I too, like Bill, have slides to share, so bear with me. A lot of the economic themes that Bill outlined are very much in play here at the region. In the region, it's been a bifurcated recovery. The recovery is uneven across industries, within industries, across communities. What we see at the national level really is playing out here regionally. So what I'll do for my portion, I'll start with an overview of regional labor markets. I'll just focus on the job market here in Southwestern Pennsylvania. And then I'll talk a little bit about monetary policy to complement what Bill had presented at the national level. And then I want to dig in a little bit into some of the trends that we see in economic disparities and economic outcomes across different communities. Before I go any further, you need to know that the views I share today are my own only and do not reflect the official views of the Federal Reserve Bank of Cleveland or the Federal Reserve System. So turning to the regional labor market, looking back in the spring, employment in Pittsburgh fell, in the metro area, fell by almost 19% from February to April. So that's basically March and April. And you see that in the table on the bottom right there. That amounts to a loss of 226,000 jobs. And that, as Bill mentioned, that put us back to the lowest level of employment regionally since the 1970s. During the Great Recession, Pittsburgh's economy didn't boom and bust to the same extent as the national economy did. That was really a source of strength for us, that we were able to have a more steady rate of growth through that time. But during this downturn, we were not immune. The Pittsburgh economy got hit very hard, very much like everywhere else. And that has to do with the nature of the downturn. Unlike the Great Recession, which was caused by an imbalance in the economy, this downturn was caused by a health crisis, which also required measures to curtail activity to stem that crisis. So that's one difference between this recession and the last one. When we look at the share of job losses by industry, in some areas, Pittsburgh looks very much like the United States. For example, leisure and hospitality, which includes restaurants, bars, hotels, entertainment venues. That industry accounted for about 1 in 3 job losses in March and April. And you see that on the orange bar there. The US was very comparable. And you see that on the vertical black line there to compare to the national economy. Where we differed a bit is that the education and healthcare sector regionally accounted for a greater share of job losses. And you see that on the second bar there, 16% of the jobs lost around there regionally, and it was closer to 12% nationally. And for us, healthcare and education is a big a big employer. It accounts for 1 in 5 jobs regionally. And so that in the initial shutdowns, with many health facilities not performing elective procedures, that really impacted the region quite a bit. Another area where we differed a bit from the national economy is in construction employment. Construction in Pittsburgh and also Pennsylvania in general shed more jobs, relatively speaking, than nationwide. And that had to do with the fact that earlier on, construction was not considered an essential industry for employment purposes, for activity. And so many builders regionally had to curtail activity, whereas if you went to Ohio, they were deemed essential, and so they continued to operate. So between those two sectors, we shed a few more jobs than nationwide, but broadly speaking, we weren't immune to the downturn. Since the spring, with the broader economy gaining momentum and reopening, the regional economy has been adding jobs steadily. On the right side, you'll see total payroll employment. This is the level. Since May, we've recovered a little more than half of the jobs that were shed, the number of jobs that were shed. So that's good. But also, as Bill mentioned earlier, there's also downsides to what we're seeing in the data. And you see that on the left-hand side with the change in employment. And what we see is since June, the increments of jobs that we've been adding has diminished. We, from our conversations with business contacts for the beige book that we produce, and this is a summary of anecdotal information that we put out on our website, many firms tell us that they don't expect to recover their pre-pandemic levels of staffing until well into 2021. At least for the first quarter of 2021, many firms expect to be below pre-pandemic levels of staffing. And a big part of that has to do with the fact that overall customer demand is still weak and doesn't justify returning all of those workers. There was a small subset of our contacts that were saying that during the crisis, they had actually become more efficient and they learned to do more with less. And as a result, they didn't need to add as many workers as they had prior to the pandemic. So all of that is to say, we're moving in the right direction, but as we look ahead to the next several months, the pace of job gains is likely to be quite slow. Another downside to the labor market that we're seeing is that the recovery really has not been even for all workers, especially for low-wage employment. The decline in employment from March to April was more severe, but the recovery hasn't been as strong, and employment in low-wage industries is still down about 20%, about 19%. And these are jobs that pay less than $13 an hour. But when you look at the other end of the spectrum, higher wage employment, the decline wasn't as steep. And in fact, according to this series from Opportunity Insights, employment in high wage occupations is actually above pre-pandemic levels. In terms of the unemployment rate, the steady gains in jobs that we've had, the moderate gains in employment that we've had over the past few months has been enough to bring the unemployment rate down. As of September, Pittsburgh's unemployment rate was at 8.2%. This is much better than the 17% that we had in April. But that said, if you look further to the left on the chart, during the Great Recession, the regional unemployment rate had peaked at 8.4%. So we're much better than we were a few months ago by this measure, but we're still at Great Recession levels of unemployment. And the other thing to keep in mind is that this unemployment rate is almost certainly understating the extent of joblessness. Regionally, the labor force is down, has shrunk by about 4% or so since the start of the pandemic. There are thousands of people that have exited the labor force. Bill brought up an issue with childcare, causing women especially to delay re-entry into the labor market. The uncertainty around schools also may play a role in that. So all of this is to say, we're moving in the right direction, but we still have a lot of challenges to overcome. For its part, the Fed, given this unprecedented economic shock, the Fed has done a lot of things to support economic activity. I'm going to go through and just summarize what we've done, earlier in the pandemic, just to give you a sense of where we were. I don't expect you to memorize all of this, but it's good to know the context here. So very early on, one of the first things the Fed did was to reduce the Fed funds rate, which is the policy rate, down to a range of 0 and 0.25%, essentially right away. And policymakers also gave forward guidance, which is communications to the markets that it intends to keep rates at this low and accommodative level until the economic crisis is passed. The Fed also, to ease financial conditions, was purchasing and is still purchasing large amounts of treasuries and mortgage-backed securities. To stabilize financial markets, the Fed ramped up its repurchase operations. It's also provided dollar liquidity to foreign central banks. The Fed also encouraged banks to lend, and it asked banks to work with their customers to modify their loan terms and to use their capital buffers to extend credit. And finally, the Fed invoked its emergency lending authority to expand or create a total of 13 lending facilities to support various parts of the economy. You may have heard of the Main Street Lending Program. That was a new program created to support firms that were too big to qualify for small business loans, but they didn't have as easy of a time accessing capital markets as the large corporations do. So the Fed looked for a gap in the economy and tried to fill it with this support. In total, these lending facilities could provide more than $2 trillion in support, but it could be much larger than that. Now, looking forward, so these were all things that were done earlier on, a number of months ago. Looking forward, in its most recent policy meeting, Fed policymakers, the FOMC, left the Fed funds rate unchanged. And in a prior communications in September, policymakers updated their projections for economic variables. And by those projections, policymakers intend to keep the Fed funds rate near 0 for a very extended time. I have this funny looking chart here. It's also known as the dot plot. It's the summary of projections that FOMC members put together. Each dot is a forecast by a participant in the committee. And what this tells us is most policymakers, there's only one Fed official that believes there will be a rate hike in 2022. 4 believe there'll be a rate hike in 2023. But essentially, the majority view is that rates will be on hold for a long time. And to give you some context, over the long run, the Fed funds rate is considered to be between 2 and 3%, somewhere around there. Now, I want to switch gears to talk a little bit about the trends that we're seeing in disparities across different groups in the U.S. economy. This is an issue that is really important to the Fed. Part of our mandate is to promote maximum employment. That's been our mandate. That's been part of our mandate for a long time. But we can't really do that if there are parts of the population that aren't fully participating in the economy. The economy can't realize its full potential if there are groups that are left behind. So this part of our mandate is important. As Bill mentioned earlier, recently the Fed revised its strategy, and now it looks at maximum employment, not just from the top line unemployment rate perspective, but it takes a broader view and thinks about inclusion as part of that. For the next few slides, I'm going to share with you some findings and some data from a variety of initiatives that we've had in the past. We conducted a policy summit in 2019 for community development stakeholders across our district. A lot of research came out, was presented there that looks into some of these disparities. I'll share with you some of that data. We also hosted a Fed Talk session last year on the racial wealth gap. And this was a public event, and there was a discussion and there were presentations discussing this. So I'll share with you some insights from that. And President Messer also spoke about economic inclusion at the African American Chamber of Commerce here in Southwestern Pennsylvania in September. And I'll share with you some of the thoughts that she presented on this topic. So to start, one way we can think about economic opportunity is to think about it in terms of income mobility. Here in the United States, we like to think that part of the American dream is that someone can work hard and increase their income, improve their living standards. So we can think of it in those terms. Now, the unfortunate news is that over time, we have seen income mobility or upward income mobility decrease here in the United States. So what this data shows you here is that in 1940, 90% of children that were born in 1940 earned more than their parents when they reached 30 years of age. So essentially, if you were born in 1940, you can expect to do better than your parents. Over time, that's diminished. Someone that was born in the 1980s, or of the children that were born in the 1980s, only about half, earned more income than their parents. Among many reasons, part of this is driven by an increase in income inequality. Since the 1960s, the median income, that's shown on the orange line there, has steadily increased from a little under $50,000, adjusted for 2019 dollars, adjusted for inflation, from $50,000 to just under $70,000. But when you look at the distribution, it's definitely not even. For those in the top 10% of the income distribution, their incomes have about doubled. And for those at the bottom 20% of the income distribution, incomes have essentially moved sideways. This gap, when it persists, can give certain groups, higher income individuals advantages, such as education or social advantages that can help them, whereas those at the bottom end of the distribution don't have those advantages, and so they don't see that, they're less able to move up the income ladder. Professor Raj Chetty of Harvard University did extensive research in income mobility. Some of this data came from him, actually. And he presented a lot of really good research at our policy summit last year. And one of the things he shared with us is that where a person lives actually explains, is an important reason, important explanatory variable in determining how likely they are to move up the income ladder. So in this map here, this map shows intergenerational mobility. Areas that are in blue, green, in those areas, children who grew up in these blue, green areas earned higher average incomes than their parents did. So they did better than their parents. Areas in red show low intergenerational mobility, and children that grew up in these places didn't really progress much compared with their parents. An important insight that this map shows is that even areas that have relatively strong economic growth don't necessarily fare well in terms of income mobility. If you look at the southeastern portion of the United States, these are areas that have experienced very strong GDP growth, output growth, strong employment growth, business formation, but those are areas that also see low levels of upward mobility. And so the takeaway there is it's not just enough to just have strong economic growth. There has to be other measures taken if we want to improve economic inclusion.
So Mikhail, I'm going to jump in where we have about 10 minutes to go, and I want to make sure we have a chance to get to some questions. So
Yes.
Apologies for cutting you off.
Oh, no problem. So, okay, so do you want to jump into questions, or do you want me to just summarize the remainder?
Sure, if you want to take 1 minute to summarize and then we'll jump into Q&A, that'd be great.
Okay. All right, so some of the takeaways, and we'll be happy to share the slides with you. The research that we've found has suggested, one, where you live matters, and you see that in different neighborhoods, and there's a map of Pittsburgh there you can find with the slides. There are differences by race. Black and white individuals that grow up in the same neighborhood with the same income parents have different levels of upward and downward mobility. So race also makes a difference. And some of these disparities create risks for long-term growth, such as creating a digital divide. Children with less access to internet don't fare as well when it comes to completing math assignments and other assignments, and that can affect their income down the road. So with all of that, some of the investment priorities that the research suggests: invest in neighborhoods and communities, place matters. Closing the digital divide is important, especially in this era. We want to increase access to quality education at all levels, and then also eliminating inequities in credit access and financial services. You can find a lot of this stuff on our website, www.clevelandfed.org, and you'll find a lot of resources there.
Okay, great. Thanks so much. And Bill and Stu, thank you for jumping in the chat and answering some of the questions so that we can get through as many as possible. And if folks are able to stay on, we might run over just a little bit so we can get through a few more questions. I think let's start with kind of a big picture, and then we'll get into some specifics that people have asked. But with the pandemic spreading and accelerating in many places, some countries have slowed reopening, some are reinstating partial lockdowns. So can you guys reflect on, is it possible to fully rebuild the economy while still maintaining certain lockdown measures?
I'll take a stab at that. So we have seen countries outside of the United States sort of have their cake and eat it too with the pandemic. This is, I mentioned China, but also South Korea, New Zealand, Australia. A lot of these countries were able to control the pandemic first with lockdowns and then with very rigorous test and trace protocols. So that is possible. But it takes to make that happen. What other countries have done first is they get the prevalence of the pandemic much lower than we've had it in the United States. And I don't know how realistic it is to expect America to lock down to that degree and to enforce the mandatory changes in behavior that they've had in those countries, which were necessary to get the pandemic to that level. So it's possible, but I don't know if America would be able or willing to do what's necessary to make it happen.
And then I think we'll move swiftly on. Mikhail, this one's for you. You gave some examples of health sector layoffs due to declining elective procedures. Are there any other insights into job losses in health or in education in the region? And as far as education goes, does that split to K-12 or higher education? Any insight?
Yeah, so that's a great question. So yes, in the hospital sector, we see administrative staff, different types of office workers also affected by this. So it ripples through in a broad way. It affects suppliers too. In education, this would be mostly in the higher ed sector. Yes, there's been some trimming of workforce, and schools are facing lower enrollment and difficult financial circumstances. So yes, it does apply more to higher education than K through 12.
And a couple questions on federal policy. So I'm going to lump a few of these together, but if you can reflect a bit on the infrastructure package, and then also on your thoughts about the US's longer term economic growth or cuts in federal spending to reduce the US's debt to GDP ratio.
So I think there's been, every presentation I've given this year, someone's asked me about the deficit, and there is a lot of concern about the deficit right now. But, Econ 101, if government spending grows infinitely faster than the economy, eventually you get hyperinflation, it crowds out private investment, it drives interest rates up. What we see right now in financial markets is that the US government can borrow for 10 years for less than 1%. The cost of capital to the private sector is low, which is kind of the flip side of what investors see, where if you want to buy capital issued by the private sector, that the price is high for investors. Price to earnings multiples, price to book multiples are historically high. And so it looks like a financial market in which savings is still abundant. The federal government's borrowing needs are not at present crowding out private sector funding needs. And since financial markets are forward-looking, it doesn't seem like the deficit is anticipated to be a problem for the United States in the near term. So I think there's fiscal capacity to deal with this crisis over the longer run. Those long-run deficit issues can, if they pop up, they can be addressed. But I think in the near term, our priority should be to get the economy back on a sound footing.
Mekael, any thoughts on those?
No, that's exactly right. The priority now is to make sure that we're in a position to be able to recover. If there's a lot of bankruptcies, a lot of business closures, that actually destroys productive capacity down the road. And so as a result, if we need that fiscal package to be able to build that bridge. And the other thing is, fiscal policy can target recoveries rather than create this blanket wave. And so targeted support could also help.
Both of you noted the pandemic is disproportionately impacting people of color and women. What can federal and local governments do to ensure that these demographics are more securely and fairly included? Another question that just came in is, how likely is it that federal stimulus dollars would flow to those disadvantaged populations? So if you can speak a little bit about equity in the recovery process.
I think I think as Mekael pointed out, the targeted fiscal spending could go a long ways. I think there are political economy challenges to making that happen in the United States. But I think there is the capacity to have that and to focus spending on communities that are being disproportionately impacted right now. I think also we can just, if the earlier we get the pandemic under control and the earlier that the private sector recovered, what we saw in 2018 and 2019 is that when the overall unemployment is extremely low, that's when the benefits of the expansion start to be experienced more broadly, and we see employment gains in Black Americans and other historically marginalized economic groups. And so I think returning the economy to full employment, and as a precondition of that, just getting the pandemic under control, I feel like it should be a very high priority in economic policy.
Yeah, that's exactly right. I agree with Bill, and I would add policies that can help help workers stay attached to the labor market will help. So things like the Paycheck Protection Program help firms keep their employees as much as they can. Those policies will help bring those people back when they can go back.
Okay, so I think we'll do two more questions. We had one come in. Do you see automation as a barrier to economic growth for future generations? And I would add to that, kind of how can states and cities reimagine their least resilient and productive sectors? You mentioned food service, retail, manufacturing being hard hit, and also while diversifying into more resilient and productive sectors, and how automation might play a role in that.
Automation, I feel like in broad strokes, is good for the US economy. Automation is something that we worry about when the unemployment rate is high, and then when the unemployment rate is low, then we see automation as a driver of higher productivity and higher wages and higher standards of living over the longer run. So I think it's something that I think it's something that creates economic progress over time. I think the way to make automation work for and have broadly spread benefits of automation is just to have a strong labor market and strong overall economy, and that will cause wages to keep pace with productivity, and those benefits to be broadly shared. I will defer to Mikhail about the question about what specific regions can do.
Yeah, that's a great question. Automation itself is not bad. It's how you deal with it. So if you're able to keep up with the changes through workforce development, you're able to retool your workforce. So workforce development is a big part of that. If you ignore that, then you will have massive disruption that leaves communities behind. So I would put workforce development as high up there.
Okay, and I know a few more questions are coming in, but I think we need to start wrapping things up. So I'd like to ask you both, kind of as a final question, what might we expect as we're exiting the fourth quarter and heading into 2021 in terms of what your outlooks are on the national and global economy?
I'm going to steal my answer from the audience. I was really struck that it's only 50% of participants who think the economy is better right now versus 6 months ago when the unemployment rate was much higher. And I think that sort of demonstrates that while people who are temporarily furloughed or temporarily laid off have gotten back to work, we are starting to see more permanent damage of this downturn. That translates into permanent job losses as well as permanent business closures. And so I think over the next couple of months, I expect the US economy to continue to recover and the global economy to continue to recover, but we're going to start to see more of those, more of the long-term costs and impact of this crisis showing up in the data that in a way is harder for us to measure in real time right now.
Mikhail, any closing?
My view is very similar to Bill's. I think in some ways we didn't see the massive business closures that perhaps we were afraid of. Fiscal policy helped with that. But as the pandemic drags on and firms have less cash on hand, that concerns me. So I think the permanent damage is something that could manifest if we don't have additional support there. And I was really surprised by the audience responses, because in our own survey of businesses in recent months, it was about half of firms that were saying that they saw demand from their customers improve recently. And so that's very consistent with what the audience is saying. It just goes to show you that it is a split recovery. There are parts that are doing really well, and there are parts that are still lagging behind. And I think we'll see more of that going into the first quarter.
All right, well, Bill, Mikhail, thanks so much for your time this morning, or this afternoon, I should say. Now I'd like to turn it over to Risa Kumazawa for closing remarks. She's an associate professor of economics in the business school at Duquesne University, and she's going to talk about some upcoming events. Thanks, everyone.
On behalf of the Economic Club of Pittsburgh, I want to thank the World Affairs Council for your partnership today. I hope that this is something that we will continue to do in the future, even when we come out of the other side of the pandemic. Bill and Mekael, we certainly learned a lot from you about the economic outlook for our region and beyond. And I also noticed that there were fantastic questions coming from the audience. And so we're grateful for that. And then if you look at the chat link, there's on the right, you'll see a link for a survey about this event today. So if you could complete this, we would greatly appreciate it. Let me mention upcoming events for both organizations in closing. The World Affairs Council is hosting a virtual conference kicking off December 1st, and the Economic Club of Pittsburgh is hosting our annual forecast meeting virtually on January 26th of 2021. Please visit our respective websites or follow us on social media for more details. Thank you very much and have a wonderful rest of the day.
Thank you.
Thank you, everyone.